Welcome to the GoldSilver.com Knowledge Center webinar. My name is Lee Greenberg, and I'll be your investor and guide. The GoldSilver.com company vision is saving the world one investor at a time. Today, our Knowledge Center agenda will include what is money, the Goldsmith Story, fractional banking, money debasement, fiat currency versus physical gold and silver, today's statistics, and we'll close with contact information. GoldSilver.com's CEO Michael Maloney is the author of Guide to Investing in Gold and Silver, part of Robert Kiyosaki's Rich Dad Advisors series of books. Since 2002, Michael has specialized in education on monetary history, economics, and financial literacy. Michael is widely regarded as an expert on economic cycles, and he has demonstrated to audiences throughout the world that economic cycles are real and that investing correctly for each phase of the economic cycle is a road to true wealth. Michael's book has been published in over 6 languages, offering insightful education for gold and silver investors the world over. Unlike the last bull market in silver and gold, this 21st century bull market is worldwide, and people everywhere are investing. So, what is money? Well, historically, money has been shells, stones, wheat, livestock, silver, and currency. But what makes money? And not everything is money. Some is currency. What is currency? Well, currency is a circulating medium of exchange, which is an intermediary used in trade to avoid the inconvenience of a pure barter system. It is a unit of account, which is a standard monetary unit of measurement of value and cost of goods, services, or assets. It is durable, which has a long usable life. It is divisible, which means it can be divided into smaller amounts. It is portable, which means it is easy to carry. And it is fungible, which means that each unit is capable of mutual substitution, meaning each unit is of equal value. The dollar in your wallet is equal to the dollar in my wallet. Money is all of the above, as well as a store of value, which is able to be saved and retrieved at a later time and be predictably useful when retrieved. Where did money come from? We'll start with the Goldsmith Story. And I thought I'd start with Once Upon a Time because our economic system is a fairy tale. But it all started with a goldsmith melting gold and minting coins. In order for the goldsmith to protect his gold and precious metals, he installed a vault in his shop. Realizing that there is available space in his vault, the goldsmith offered to rent space to the public to store their valuables. And the customers lined up to store and protect their valuables. Customers would purchase gold coins from the goldsmith, and he would store them in the vault. And when gold coins were stored in the vault, the customer would receive an IOU, or a claim check, a paper ticket, a bank credit, to be redeemed at a later date. These goldsmiths' IOUs became acceptable means of currency for trade because the merchants knew they could always redeem the claim check for the actual gold in the goldsmith's vault. Once the goldsmith began renting space in his vault and generating profits, he was able to offer loans against his gold that was in the vault. He would create an IOU in exchange for a promise to pay signed for by the borrower. But the goldsmith, now the merchant banker, realized that rarely did customers remove all their gold from his vault, that he could loan IOUs against the gold in the vault without ever having to remove the gold from the vault. All he had to calculate was a percentage of the gold that could be available for customer withdrawal at any time. The amount above could be loaned against. Thus he made a much larger profit than with just his bank loan and vault rental business. This was the creation of a current banking system known as fractional banking. As long as the vaults had stored gold, the bank can loan against a fraction of the vault holdings. Most bank loans are backed by a small holding. The banker's nightmare is when all holders request to withdraw all their demand deposits at the same time. This is called a run on the bank and will put the banker out of business. Bank loans require the loan amount to be equal to the deposit amount. Fractional banking, or fractional reserve banking, is the banking practice where banks keep only a fraction of the deposits in reserve and create the remainder as checkbook money, while maintaining the simultaneous obligation to redeem all these deposits upon demand. In this example, 10 IOUs are equal to 1 gold coin. Fractional banking became legal in 19th century England and is legal and common practice today in the United States of America. The percentage of reserves used to be 10%, but today the reserves are typically zero. By studying history, we can see again and again how empires typically come about and then fail. Here we have an example of the fall of Rome. The majority of empires begin with sound money in gold and silver. They grow and overexpand and overreach militarily, and eventually they are forced to debase their currency. Does this sound familiar to you? You can see by this chart the slow extracting of the Roman denarius silver content over 130 years. Starting in 193 AD, and over the next 40 years, the Severian emperor debased the silver content from 78.5% to 50% silver. This chart ends with the fall of Rome and Emperor Aurelian in 274 AD with the silver content at 5%. The silver denarius no longer had any intrinsic value. Here in the United States, we have been more efficient in our own silver coinage's debasement. Beginning in 1965, silver was taken out of our quarters and dimes, and then all the silver was withdrawn from our circulation by the mid-1970s. Here is a modern-day example of what can happen to fiat currency when things go bad. In 1980, one Zimbabwe dollar was equal to $1.47. And in 2008, 100 trillion, that's T for trillion dollars, were worthless. After the Civil War, the classical gold standard came about with the bankers controlling the supply of gold up to the gold rush at the turn of the century. Gold was used as money, as a special coinage depicted above. World War II saw the breakdown of the classical gold standard, as many countries had to finance the war with debt. During this period, we also saw the U.S. nationalize the public's gold with Roosevelt's executive order in 1933, backing the U.S. dollar with 22% of the gold held by the public melted down and moved into Fort Knox. The remainder of the public's gold was hoarded and not turned in. Nobody ever went to jail for not complying with the executive order, and those same hundreds of thousands of pre-1933 semi-numismatic gold coins are still around today. Then came World War II and the Bretton Woods Agreement at the end of the war, which made the U.S. dollar the world reserve currency. So fiat currencies like the lira and the yen were backed by U.S. dollars, which were in turn backed by the gold at Fort Knox at $35 per ounce. Then numerous wars and entitlement spending and currency expansion forced President Nixon to close the gold window in 1971. Once he did this, the entire monetary system became 100% fiat as a world reserve currency. So we've briefly looked at the last 4 monetary systems, typically having life cycles of 30 to 40 years. As you can see, today's fiat currency reserve standard is reaching the end of its 40-year cycle. So what will be the final catalyst which will bring on the next monetary system? One thing is clear: the dollar's days as the world reserve currency are numbered. We believe in the financial chaos ahead. Real money's gold and silver will be doing some serious accounting work for all the fiat currency creation that has taken place over the last 40 years. So let's look at our current times. In the United States, it took 200 years to build a monetary base to $850 billion. That is all the cash in your pockets and all the currency in the economy. And since 2008, we have increased the currency supply to over $2.1 trillion. That is almost a 2.5 times increase in the money supply in 2 years. If we add all the bank's deposits to our measure, it is called M3, which now exceeds $14 trillion. This next chart shows the budget deficit since the 1960s as reported by the U.S. Congressional Budget Office. These are the numbers reported to us, and this is the adjustment to reflect the real deficit. And if we view in yellow the government's projection for the deficit into the future, then based on the past error ratio, these are the future deficits. This chart is the ratio of the U.S. debt versus the U.S. GDP, which is the gross domestic product, a measure of the country's overall official economic output. This historical timeline shows major events: the Civil War in the 1860s, World War I, and the Great Depression all did not exceed a 40% ratio. We see the Korean War, the Vietnam War, and the spike that occurred at World War II, which then tapered off. Please note today that in 2010, the ratio is 97%. And when we project out over the next 50 years, based on the Congressional Budget Office figures, we reveal a mind-numbing chart. And here, the U.S. national debt is projected to grow to $25 trillion in the next 10 years. At GoldSilver.com, we believe in protecting yourself and your hard-earned wealth by investing in physical gold and silver. The GoldSilver.com difference. GoldSilver.com is first an educational company. Michael Maloney is a cycles investor, and this is the precious metal cycle. Our number one priority is that our customers are educated as to how to protect their wealth by investing in physical investment-grade gold and silver. What differentiates GoldSilver.com is our information flow to our customers in the form of newsletters, emails, webinars, industry news, and education. Inclusive, our customers will receive Michael Maloney's exit strategy in the future when he moves out of his silver and gold investments, and why. We only handle physical gold and silver bullion. We have competitive pricing. One of the many benefits of gold and silver is its liquidity, and GoldSilver.com will buy back any of the products we sell at the current rate. And we carry only the most recognizable mint hallmarks: the U.S. Mint, the Canadian Mint, the Austrian Mint, Credit Suisse, and Johnson Matthey. Our newest website is wealthcycles.com, a financial education-based website on cycles investing. Subscribers always rave about how much content they receive there for the price. It is a tremendous value. Wealth Cycles' mission is to empower individuals with knowledge and understanding of economic wealth cycles, enabling them to ensure and secure a financial future for themselves and their families. Please visit us at www.wealthcycles.com. For more information, please email us at support@goldsilver.com or call us at 888-319-8166. Again, email is support@goldsilver.com, and our phone number is 888-319-8166. Thank you for joining us.